welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Pieter van der Zwan, and in each episode I share my thoughts with you on a topic relating to South African tax or a recent development. And I'll do my best to keep it within the time that you need to make yourself a good cup of coffee if you need a break from work. Our topic for today is Section 24C of the Income Tax Act. Now, this is a section that SARS often looks at when they do reviews or audits. And in my experience, it's also one of the areas where quite often you find that there are adjustments to tax assessments. Now, while if we look at Section 24C at face value, it seems quite a simple provision. But I think the reality is it is actually quite complex. There's many elements that you need to consider. It's very fact specific. And I think that is evident from the number of tax cases on Section 24C. So we are not going to cover all aspects of Section 24C today. What I would like to discuss is the link between the deduction claimed under Section 24C and the accounting treatment of the transaction. So before we go into this link that there may or may not be, let's perhaps take a step back and just revisit the concept of what exactly is Section 24C about. So if we look at the title of Section 24C, the title of the provision is an allowance for future expenditure in respect of contracts. So what that tells us is it's a provision that's intended to give you a deduction, an allowance, and it deviates from the normal principle that you can only claim a deduction once you've incurred expenditure. So 24C would actually give you a deduction before you've actually incurred the expenditure. Now, the crux of Section 24C sits in 24C2, and it says that the taxpayer must have received or they must have accrued an amount to the taxpayer in terms of a contract. So there must have been a receipt or accrual, and this receipt or accrual must have been included in the taxpayer's income for the year of assessment. So in other words, the person must have been taxed on this amount. Very interesting to note at this point, there is no requirement in 24C2 itself that refers to the accounting treatment. There's nothing that says that this amount must have been recognized as revenue in advance, which is often where the point of contention comes in. I'll return to that a bit later on again. The second requirement, so we've got the amount that must be income or must have been included in income. The second requirement of the legislation is that this amount, this income, must be utilized in whole or in part to finance future expenditure that the taxpayer would incur to perform its obligation under the contract. So practically what it means, you need to identify what obligations will arise under the contract. And secondly, you need to then link those obligations to expenditure to say, but what would the cost be to fulfill these obligations? And in my experience, taxpayers are quite good at identifying the obligations and estimating what the cost would be. But then, and this is where the debate often happens, the taxpayer only qualifies for the allowance for these future expenses that you've now identified, to the extent that the future expenses will be funded from the specific income that's already been received or accrued. So this basically implies that what you can't get a Section 24C allowance for is future expenditure that will be funded from something other than the income that you've already included in your taxable income. So put differently still, your future expenses that will be funded from future income in terms of the contract would not qualify for a Section 24C allowance. And I think this is where the overlap between accounting and Section 24C could come in. And I'm going to use or refer to IFRS 15, the accounting standard on revenue recognition, to explain this. So if we look at revenue in advance from an accounting perspective, that essentially represents the revenue, the amounts that you've received, but you haven't earned them yet. So put in IFRS 15 terms, This is the income that relates to your performance obligations that you have not yet satisfied. So you still need to perform these obligations. Now, although the correlation is not perfect, and as I mentioned to you, the Income Tax Act doesn't refer to the accounting treatment, your revenue in advance number is quite a good proxy of the income that you will use to still fund future expenditure. So the income that you've already received, where you still have an obligation that you need to do something in future. So that's where the linkage is. If we then take perhaps a step back to say, but how much of this income will be used to fund future obligations? And that's really always it's a factual question to say, of this income that you've got, what will you use to fund the future expenses? Will it be this income or something else? I think we need to take a step back to look at Section 24C a bit more conceptually to answer that question. So, in essence, Section 24C is really a form of a matching provision. So let me explain what I mean by that. If the person has received income but not yet incurred the costs relating to that income, then the taxpayer will be taxed on the income only. Whereas if you look at the normal scheme of the Income Tax Act, taxpayers are taxed on profits, not on income. So what 24C really attempts to do is to say that where you already have the income included in your taxable income, this gives you an allowance to try to get you to the same answer that you would have been had you already incurred the related costs for this income. So in other words, to only tax the taxpayer on the profits that it will make from this transaction. So this income would have a profit component in it and a portion that would be used to fund the costs. And that's how you arrive at the profit. So 24C is really intended to make sure that at no point in time you pay tax on the income element only, but that you are taxed on the profit. So that gives you a good guideline of how do you need to determine how much expenses are going to be funded from this income. Right, when it comes to the provision, there's a lot more complexity to it, and we see that in the case law. There's questions about what types of contracts are we looking at, whether it must be a single contract or whether you could have multiple contracts that you need to view together. There's a few cases on it. For example, the Clicks case on how to apply this provision in the context of customer loyalty schemes. There's a Big G Restaurants case. And I may touch on these in future episodes, but I think for now, let's close off our episode. So what are the points to take home? I think firstly, Section 24C seems fairly straightforward, but it's actually not. The application of 24C is very fact specific. So you need to really understand the commercial side of the transaction that you are looking at to apply Section 24C properly. And lastly, I think it would help you to apply the provision if you take a bit of a step back and consider what the provision was intended to achieve, being that you should be taxed on the profit that you will make from the income that you've already earned, not on the gross income only, without recognition for the related costs. Right, that's about all for this episode. Thank you for listening, and if you enjoyed the podcast, please subscribe on your podcast platform and tell all your colleagues and friends about it. If you have any questions that you would like me to consider in a future episode, you are welcome to email it to me. My email address is in the show notes. And maybe just a reminder, as always, nothing in this podcast should be construed as tax advice or even a substitute for fact-specific tax advice. Until next time, goodbye.